Okay, let's talk about the various tools that can help us perform both a risk and a ratio analysis related to a company's financial statements. There are three main topics we need to discuss here: ratio analysis, default risk, and operational risk. Let's break each of these down. First of all, ratio analysis. It's the most common method of evaluating both the risk and performance of a firm, such as liquidity ratios. Then we have default risk. It's a key type of risk that evaluates a firm's ability to pay its obligations, such as financing ratios, which are very important for our creditors, the folks we owe the money to. Third one is operational risk. It relates to how adept a company is at being able to withstand various events that might impair its ability to earn profits, such as internal controls. This should help us prevent fraud, which we talked about in an earlier module. You definitely don't want to be included on the list of top 10 fraudulent accounting scandals. The two most common types of liquidity ratios are our current ratio. It provides an indication of that firm's ability to pay its short-term obligation, measures our relationship of working capital, which is basically current assets minus current liabilities. Our current ratio is current assets divided by current liabilities. For example, a ratio of 2.0 would indicate there's 2 times as many current assets as its ability to pay its current liabilities. We can compare this to an industry average or show a trending of the company ratios. The other measure is the quick, or also sometimes called the acid test ratio, much more stringent indication of our ability to pay its current obligations because it excludes inventory, prepaid assets, and deferred taxes from the numerator. Thus, we only include those current assets that are most readily converted into cash. The quick ratio calculation is quick assets divided by current liabilities. We define quick assets as the cash, short-term investments, and our receivables. Again, I would compare this ratio to an industry average or show at least the trending of our company ratios. Now let's look at the two most common measures of our financing ratios. First of all, we have the debt-to-equity ratio. It provides a measure of credit protection in the event of an insolvency. The higher the ratio, the higher the risk. This compares our resources provided by creditors versus shareholders. An example would be a ratio of 0.5 would indicate that the company is financed by equity twice as much as it's currently being financed by debt. Our debt-to-equity ratio is total liabilities divided by total shareholders' equity. Our next ratio we're going to talk about is called times interest earned, or TIE. It's a good indication of our margin of safety. It compares our fixed debt interest charges with the income available to pay those charges. The higher the ratio, the higher the margin of safety for our creditors or bankers. An example would be a ratio of 10.0 would indicate that the company is very well positioned to pay its fixed debt or interest charges. Creditors would feel very comfortable that they'd be able to be paid their interest charges on a very timely basis. The TIE ratio is net income plus our interest expense plus our income taxes divided by the interest expense. Please note that that numerator can also be expressed by a more common financial term called EBIT, which stands for earnings before interest and taxes. Is this all making sense? I hope so. Let's keep going on to the next lesson.